Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today, we're taking a deep dive into a stack of recent financial news. We've got pieces from CNBC, Yahoo Finance, Reuters, Bloomberg, all hitting the wires between September 17th and 18th, 2025.
Yep, a busy couple of days.
Absolutely. Our mission today is, well, to unpack the biggest stories shaping the global economy right now. We'll try to connect the dots, give you the context you need.
And maybe highlight some of those surprising insights. Help you stay informed without feeling totally overwhelmed.
Exactly. Think of it as your shortcut to understanding these complex currents driving the markets. Like, can the Federal Reserve really walk this tightrope between a softening economy and sticky inflation?
Or are we heading for some kind of collision?
That's the question. Today, we'll dissect the signals, try to reveal the true risks, and maybe the opportunities for your portfolio. Okay, let's unpack the biggest headline first. The Federal Reserve cut its benchmark interest rate.
That's right, by 25 basis points on Wednesday, 0.25%.
So that puts the overnight funds rate in a range between 4.00% and 4.25%. And this is the first cut this year, right? Since last December.
Right. But what's really fascinating here, I think, is that while everyone pretty much expected this, it wasn't unanimous.
Oh.
No, it was an 11-to-1 vote.
Uh-huh.
Stephen Mirren, he's a new Fed governor, a former Trump advisor, he actually dissented.
Okay, what did he want?
He was pushing for a larger cut, a half-point cut.
Wow. So more aggressive easing.
Exactly. And this isn't just, a little internal disagreement. It suggests there might be a faction pushing harder, which could definitely shift market expectations down the line. It tells you the debate inside is probably quite intense.
That is a powerful detail. Now, Fed Chair Jerome Powell, he described this as a risk management cut, suggesting caution, not like a panic response to a weak economy. But, I mean, given some of the other signals we're seeing, is that the whole story? Is he maybe downplaying things a bit?
Well, connecting this to the bigger picture, Powell's phrasing, it really points to the incredibly tricky spot the Fed is in. They're juggling this persistent inflation.
Still too high, right?
Yeah. PCE inflation is at 2.59%, core CPI at 3.1%. Both are, stubbornly above their 2% target. And these aren't the volatile numbers. PCE and core CPI strip out food and energy.
Right. So underlying pressure.
Underlying pressure, exactly. It suggests inflation isn't just a temporary supply shock thing anymore. It's maybe more embedded. And at the same time, you've got this clearly softening labor market.
So they're trying to avoid
stagflation. That's the big worry. That awful mix of sluggish growth and high inflation. It's a nightmare for central banks. As Kevin Gordon from Charles Schwab noted, in this kind of supply shock-driven economy, the Fed's tools are, well, limited.
It really sounds like they're trying to thread a very, very fine needle. And policymakers also signaled more cuts potentially coming.
Yeah, they signaled possibly 2 more this year, maybe October, December, then another one in 2026, 1 more in 2027, and then none in 2028, looking way out.
Okay, but that outlook for next year, just 1 cut, that's a bit more hawkish, a bit tighter than maybe traders were thinking?
It is, and this raises a key question. Why the gap between the Fed's view and the markets? If you look at the Fed's dot plot,
which is their internal forecast survey, basically.
Right, anonymous projections from each official. It shows a really wide range of views on future rates. Some see the rate hitting 4.4% by year end. Others see it as low as 2.9%.
That's a huge spread.
It is. And that spread isn't just internal debate. It's a signal to the market. Policy is highly uncertain.
Right.
Josh Hurt of Vanguard mentioned this specifically. It often leads to more market volatility as traders just struggle to price things in. So for you, the listener, it just means more unpredictability ahead.
And all this is happening while the U.S. labor market looks, well, concerning. The Bureau of Labor Statistics, their latest report, only 22,000 jobs added from July to August.
Barely moving the needle.
Right. And big downward revisions for earlier in the summer, too, showing hiring slowed down more than we thought. Gregory Dacco from EY Parthenon even said we're likely to see job growth basically hovering around 0. That doesn't sound solid.
No, and significantly, the Fed actually dropped that word solid from its statement when describing the labor market.
Ah, okay. A subtle but telling change.
Very telling. The unemployment rate ticked up to 4.3% in August. That's the highest it's been since October 2021. And long-term unemployment, people out of work over 27 weeks, that reached 25.7%. So for you listening, this isn't just abstract data. It reflects real struggles out there.
And what's really striking, I thought, was the impact specifically on younger workers. There was research mentioned from Stanford's Ryu Chen, pointing out that entry-level jobs, the ones often involving textbook knowledge that AI models are good at learning, those are getting hit disproportionately.
Yeah, that's a worrying trend.
We've seen sharp drops in software developer roles for people in their 20s since 2022. Young marketing and sales managers are apparently struggling too. If you're just starting out, that's tough. Your career path might be getting reshaped by AI right now.
And it's not just AI, right? Wells Fargo CEO Charles Scharf mentioned that businesses are just being really cautious, very prudent about hiring. Why? Because of all the uncertainty around federal policies, taxes, tariffs, immigration.
So they just hold back.
Pretty much. It
Yeah.
creates this kind of no hire, no fire market we're hearing about.
Hmm.
And then you hear these anecdotes, right? People like Sashi Kayard, Felicia Enriquez,
Yeah.
Dylan Tide, sending out hundreds of applications, getting nothing back.
Ugh, yeah. The human side of it.
Absolutely. And layer on top of that these ghost jobs postings that aren't really open, plus AI screening applications. It just makes the job hunt incredibly difficult right now.
Okay, so the Fed's making this cautious risk management cut. The job market's looking weak. What did this actually do to the markets? How did investors react?
Well, U.S. stocks were mixed, kind of a split decision. The Dow Jones actually rose 0.6%, even hit an all-time high during the day.
Okay, some optimism there.
Maybe. But the S&P 500 slipped 0.1%, and the NASDAQ lost 0.3%. So tech and broader market weren't quite as cheerful.
So that divergence, Dow up, S&P and NASDAQ down, is that a theme itself? Maybe some sector rotation going on?
That's a really sharp observation. It could signal worries about growth affecting tech, while maybe money moves into more established industrials. Jim Cramer's take was basically, no big themes were upended, don't make huge moves just based on the Fed.
Easy for him to say.
Right. But that divergence is interesting. And Treasury yields also showed this mixed feeling. Short-term yields dipped a bit, reflecting the rate cut.
Okay, some immediate relief.
Yeah, but longer-term yields actually saw some increases, which isn't exactly what you want if the Fed's trying to ease conditions broadly. Gina Bolvin from Bolvin Wealth Management Group put it well, I thought. She called the Fed's move modest rate relief, not fireworks.
Yeah, that fits. No big bang.
Exactly. The market isn't fully convinced this is the start of a major easing cycle. And that split in the stock indices definitely suggests some rotation, maybe a flight to perceived safety within equities.
And these ripples went global, didn't they?
Oh, absolutely. In Asia, Japan's Nikkei 225 actually hit a fresh record high, up 1.15%. Real estate and tech leading the way there. South Korea's Kospi also had a good day, up 1.40%.
But not everywhere.
No, Hong Kong's Hang Seng Index slipped 1.31%. So definitely regional variations.
And Europe.
European markets mostly opened higher. The Stoxx 600 was up about 0.5%. Banking stocks generally did well. So some initial optimism, maybe relief. But again, it's not universal.
Yeah.
The Bank of England, for instance, they're expected to hold their rate steady at 4%.
So different paths globally.
Different paths, exactly. And for you listening, these varying reactions aren't just about the Fed. They reflect how each region's economy is positioned and the different strategies their own central banks are using. It's complex.
Okay, beyond interest rates, trade policies are clearly still a huge factor. Look at Hyundai.
Yeah, interesting case. They raised their 2025 revenue forecast, which sounds good.
But they lowered their operating profit margin forecast. Why? Ongoing U.S. tariffs.
Right. It shows how those macro factors can really bite into profitability, even if sales are growing. And on top of that, they had that massive immigration rate at their Georgia battery plant. Hundreds of workers arrested. Just another layer of disruption.
And the tariff impact elsewhere.
It can be really stark, especially for smaller economies that rely heavily on trade. Take Switzerland. Remember that new 39% U.S. tariff that kicked in August 8th?
Vaguely, yeah.
Well, Swiss exports to the U.S. just collapsed in August, down 22%. And gold exports specifically plummeted 99% compared to July.
Wow, 99%.
99%. Now, Switzerland's trying to diversify, find other markets,
Mm-hmm.
but it just highlights how immediate and, frankly, brutal these tariff impacts can be. For you as an investor, it's a potent reminder. Geopolitical moves hit balance sheets fast.
And we can't forget the tech sector tensions. China reportedly banned an NVIDIA AI chip.
Yeah, the RTX Pro 600D. It was a chip NVIDIA, custom-made specifically for the Chinese market to comply with previous restrictions.
And now it's banned anyway.
Seems so. NVIDIA's CEO Jensen Huang expressed disappointment. But here's the interesting twist. Other Asian chip stocks like SK Hynix, TSMC, Samsung, they actually rose on the news.
That feels backwards. Why would they rise?
Well, it raises this important question about the tech rivalry, right? The ban suggests China's maybe doubling down on developing its own tech, accelerating that decoupling, and the rise in other Asian chip stocks. Maybe investors think those companies will pick up some slack or benefit indirectly as supply chains reconfigure. It's like this complex dance of competition and shifting
A
opportunities.
recalibration.
Exactly. Recalibration of supply chains, tech dependencies. It impacts all the key players. Oh, and another trade ripple. FedEx is expected to take a profit hit. Why? Because President Trump ended that de minimis tariff exemption.
The one for low-value packages from China and Hong Kong.
That's the one. Ending it means more packages face tariffs, which directly hits shipping volumes and costs for companies like FedEx. Policy changes have real consequences.
Okay, now for something really fascinating, an anomaly almost. We're seeing this strange pattern in India.
Ah, yes, the IPO story.
Foreign investors are actually net sellers of Indian stocks in the regular secondary market, but they're net buyers in Indian IPO's initial public offerings.
Yeah, the numbers are pretty stark. Since 2024, they've pulled out about $14.4 billion from the secondary market.
But plowed $14.5 billion into the primary market, into IPOs. It feels like a contradiction. Why leave through one door and rush in through another?
Well, what's fascinating is that it's likely not a contradiction at all. It looks like a very calculated, quite smart strategy.
How so?
It comes down to valuation, basically.
Yeah.
The simple math is, the MSCI India Index, it's trading at a price-to-earnings ratio of around 25.4x.
Which means investors pay over $25 for every dollar of earnings.
Right. Compare that to the broader MSCI Emerging Market Index that's around 15.4x. And places like China and Korea are even lower. So from a pure valuation standpoint, the main Indian stock market looks, well, expensive. Overpriced, perhaps.
Okay. So the secondary market looks pricey, and IPOs offer a better play, a cheaper entry point.
Potentially, yes, or at least a different kind of opportunity. And the returns certainly back that idea up. Indian IPOs in 2024 delivered returns of, what, 37.1%?
Compared to just over 7% for the main stock market index. Big difference.
Huge difference. Alexander Trees from JP Morgan Asset Management put it nicely. He said IPOs give investors a chance to build positions in new companies at a transparent price. And you're tapping into India's really attractive background story. Strong GDP growth, great demographics, good quality companies.
And India's IPO market itself is booming.
Right. Absolutely booming. Ranked #1 globally in IPO volumes in 2024. They listed almost twice as many companies as the U.S. But here's the deeper insight, I think. It's not just about PE ratios. It signals that India's domestic capital market is now strong enough to support this primary market activity.
You mean local Indian investors?
Exactly. Strong flows from domestic institutional investors have deepened the market, improved liquidity. Equity mutual funds there have seen net inflows for 54 months straight. That's incredible.
Wow. 4.5 years.
Right. And this strong domestic buying gives foreign investors confidence. They know they can participate in big IPOs without worrying about getting stuck if they need to sell later.
Right.
Hiram Dasani at White Oak Capital mentioned this. It creates a virtuous cycle.
Domestic money attracts foreign money, which attracts bigger deals.
Precisely. Like the upcoming Tata Capital IPO expected to be $2 billion. LG Electronics' Indian subsidiary is also planning a big one. It shows India is becoming a real destination for fresh capital, not just secondary market trading. It's a unique, self-sustaining ecosystem developing.
Fascinating dynamics. Okay, let's shift gears to some specific company stories. Cracker Barrel. Their stock's been falling.
Yeah, they cut their full-year outlook. They're projecting less traffic, lower sales.
And this follows that whole controversy where they tried to revamp their logo and store look, right? And got huge backlash.
Massive backlash. From customers, even drew comments from President Trump last month. They tried to modernize, I guess, but completely misjudged their core audience.
Or they're reversing course.
They are. CEO Julie Masino basically admitted they misstepped. They're going back to the old-timer logo, the traditional interiors. But the damage seems done for now.
What's the financial hit look like?
Well, their adjusted EBITDA, that's a key profit measure, is expected to fall significantly in fiscal 2026. And the CFO specifically said traffic dropped about 8% since that logo change hit in August.
Ouch. A clear lesson in knowing your brand and your customer.
Textbook case, really. Brand loyalty is powerful, and you ignore your base at your peril.
Okay, on the innovation side, Meta. They unveiled new smart glasses.
Yeah, their first ones aim squarely at consumers, not just developers. They're Ray-Bans, priced at $799. Built-in display, hand gesture controls via a wristband.
So pushing further into AI and the metaverse?
Definitely. It shows their continued heavy investment in those areas. And as the JP Morgan analyst pointed out, they can afford to make these big long-term bets because their core advertising business is still so strong, it's a strategic play for the next wave of computing.
Right. Shifting continents again, Australia. Santos, the gas producer.
Big drop in their shares, over 11%. Wiped out about $2 billion in market value.
Why?
An $18.7 billion takeover bid, led by AD&OC, was aborted. It fell through. And this is the third time a sale attempt has failed for Santos.
Third time unlucky. That must put huge pressure on management.
Immense pressure. Shareholders are going to be demanding action now, boost returns, maybe change strategy. One analyst, Josh Russellman, even suggested they might need to consider selling off some of their LNG assets, liquefied natural gas. They're at a real crossroads.
Got it. And just a couple of quick hits to round things out.
Sure. Novo Nordisk, their stock, got a boost from trial results showing significant weight loss from their obesity pill, Wegovy. That drug continues to be a major story.
Huge market.
Massive. And Disney stock held steady, interestingly, even after ABC pulled Jimmy Kimmel Live indefinitely. That followed a backlash over comments Kimmel made about Charlie Kirk.
Highlights that tricky line media companies walk these days, doesn't it?
Absolutely. Balancing creative freedom, audience reactions, political sensitivities. It's a minefield.
Okay, so we've covered a lot today. We unpacked the Fed's cautious rate cut, this backdrop of a weakening U.S. labor market, but still sticky inflation.
Looked at the mixed reactions in global markets, stocks, bonds.
Touched on the real impact of tariffs on trade and companies like Hyundai and Swiss exporters.
Dived into that fascinating dynamic with Indian IPOs attracting foreign cash, even as they sell other Indian stocks.
And wrapped up with some specific company news, Cracker Barrel's branding blunder, Meta's tech push, Santos's failed deal.
Yeah, quite a tour.
So the provocative thought to leave listeners with, as central banks try to navigate these really complex currents and companies are forced to adapt to geopolitical shifts, new tech, maybe the biggest challenge for all of us policymakers, investors, you listening, is figuring out what's a real fundamental shift versus what's just temporary noise.
That's the billion-dollar question, isn't it? Is this Fed risk management cut the start of smoother sailing ahead, or is it just a brief pause before things get even choppier? Discerning those signals? Well, that's key for making informed decisions in this market.
Indeed it is. That's it for today's Deep Dive. We'll see you all tomorrow morning with new headlines from major financial magazines.